A candle range theory trader back with you for another video on how to find trend reversals using the candle range theory. So let's not waste time and get right into it. What this video is going to cover is the materials and indicators that you will need, the setup to look for and where it's located, what has to happen first, what happens next, your profit goals, and a special bonus hack. So be sure to watch this video to the end so you don't miss that. So in terms of setting up your chart, this is what you're going to need. You're going to need the ATR candle size indicator. If you do not know what that is, or you have no idea what I'm talking about, you need to pause this video and go to the description and look at the video called what is the ATR candle indicator? Watch that. And you'll need a 20 EMA. If you don't know what that is, you'll need to go to the description once again, look at the video entitled, What is a Baseline? And that will explain the 20 EMA and its function for the sake of this trading system. But that's all you'll really need, just those two. So what happens first? What are we looking for when we come to the chart, when we're trying to find a reversal? If you're trying to go long, what you're looking for is a blue ATR candle below the 20 EMA on the 4-hour chart. And this screenshots and everything that you're going to see is going to be tailored to the 4-hour chart. And the opposite is true for a short trade. So it's just the opposite. If you're trying to go short, you want to see a yellow candle, yellow ATR candle, the bigger the better, above the 20 EMA. Okay, above the 20 EMA. This is what has to happen next. And I'm going to show you this. I'm describing it first, and then you'll know it when you see it when I show you these two examples. So after you enter using the standard candle range theory method, and if you're not familiar with that method, you'll need to, once again, pause this video, go to the description, look at the video entitled, What is the Candle Range Theory? That explains that in detail. You have to know what the theory is in order to trade this. Okay, so we're building on things here. After you enter the trade using the regular candle range theory, these two things must happen to make it a legit swing trade or reversal, whatever you want to call it. If you are long, the price has to break out above the range. And if you are short, the price has to break out below the range. In other words, the ATR candle. And then the last thing that has to happen, and the order of these may flip-flop, but the price has to close above the 20 EMA if you're long, or below the 20 EMA if you're short. So let's see how this looks. So these two things are what you're looking for: a breakout of the range and price closing above or below the 20 EMA. So this is a short example. Let's take a look at this. So once again, we're going to go through our steps. First thing we need to see is an ATR candle above the 20 EMA. This yellow candle right here meets that criteria. And once again, the bigger the better. All right. So we see these next few candles here are developing at the range, but they're not breaking it by more than 25 pips. So even though price is still closing above the range, it's not as significant enough of a close to make me think price is going to keep continuing higher. Now, the hard fast rule is this. If the price closes, okay, so you may deal with a little bit of drawdown if you're trading at the extremes of the range. But if a 4-hour candle closes 25 pips above the trade, close it out. Okay, it's probably going to keep going. Okay, that momentum is not slowing down. But if it's closing, say 10 above, 20 above, 5 above, trade's still fine. Okay, trade's still fine. So what's next? The step 2, price eventually does close inside the range. Not only that, it closes below the baseline, which is our 20 EMA, the blue line you see there on the chart, and I could put a big old arrow there so you can't miss it. That's the next thing that you have to see. It has to close there, not tap it, not pin it. Close below that line. That confirms that this is indeed a trend reversal. And then the last thing we want to see is price continuing to tank. So I had to zoom out a little bit here because there were a lot of candles on this 4-hour chart. But the close outside of the range is next. And you see this black arrow here. My cursor is circling it. That's when price closed outside the range. It went down, pinned the top of the range, and also our 20 EMA, and then tanked again, right? So this trade is safe to hold as long as price is held by the 20 EMA. Okay, so it went down about 150, 200 pips, but it went for a total of 400 pips before completely retracing down here at the bottom all the way back up. So you want to be out by the time this happens. All right, you want to be out by the time all this happens. In terms of a take profit, if you look left a little bit, possible areas of take profit can be prior lows if you have the patience for that. But that's just one thing you can shoot for. So now for our long example, our first step, once again, is to find a blue candle below the 20 EMA. This is that right here, okay? That right here. And then also the money candle does appear here where price pokes below the candle range and closes back inside of it. So this is our range to start dealing and going long. Okay, that's step 1. Step 2, wait for price to either, we want to see one of two things: either price to close above the 20 EMA or to break out of the range. In this case, it closed above the 20 EMA first. All right. Now, and you notice this pin right here to the 20 and close below. See, that's not a close underneath it. That's not it. We want to see it close above the 20 EMA if we're long. That's our confirmation that this trade should be good to continue to hold. And that trend is in the midst of reversing and continuing up. And then our last step, once again, we had to zoom out because there's quite a bit of movement here. But you'll see our entry all the way down here where this black line is, and price just simply skyrocketed. It was held by the 20 EMA with a little bit of drawdown. That's going to be normal. But as long as it's inside the range and contained in the range, you're good. Price didn't even touch the entry. It didn't even come back to that level. It retraced some, but then eventually it did find its footing and then just skyrocketed up. So the breakout of the range is the last step. You are not trading at this point. I only teach one entry at as close to the bottom of the range as possible, and then you just ride it up for profits. So you're always welcome to hold for 100 to 200 pips or more. This trade went for 428 pips, 428 pips before coming back down. So here's the prior high right here that you can aim for a possible take profit. Other prior highs, I mean, you could aim for this one, this one, this one, or even this one. That's up to you. I'm not going to tell you which ones you should shoot for. That's going to be your call. All right. So again, your take profit levels using this method, I'd say it's good to expect about 100 to 200 pips. That's more than enough for me, right? But you have to decide for yourself. And prior highs and lows can be good take profit levels for more pips. But again, that's going to take a while. So if you got to wait for that. If you want more pips, you have to wait longer for that typically. And please keep the average true range of a pair in mind. So if an average true range on a pair is like 35 pips a day, don't expect to get 400 pips. It doesn't really work like that. It's unrealistic. All right. So the higher the ATR, the more likely you are to get more pips from that. The special bonus hack that I did promise near the end of the video was this. If you go short above the prior month high or the prior week high, or if you take it long below prior month low or prior week low levels, those are going to be the best, okay? Because there are oftentimes people that sell at lows and they buy at highs. We want to do the opposite. So when the pigs are buying, you want to be selling. When the pigs are selling, you want to be buying. Everybody who sold, just to use that as an example, everybody who tried to short this got destroyed, okay? This is where you want to, people who went to sell down here, they got destroyed. People who were buying, or let me reverse that. People who tried to sell short here, they got killed. Right? And then for the other example here, we'll go to the finished product. Everyone who was trying to buy at these lows here and like here, trying to buy on the way down, trying to catch a bottom, got destroyed. Okay. These are the pigs who are trying to think they're looking for a continuation, not understanding that the trend, or at least for this time period, has reversed. Okay. So when they're buying up here, you are selling. And then when they sell, you buy. All right. So just do the opposite. Right. I hope that makes sense. And again, when this price here is above a prior week high or low, or above a prior month high or low, that's the optimum time where your risk or your chances are much greater of this setups like these playing out. Above prior month high for trades like this, or prior week high for trades like that, and then below a prior week or month low to get into trades like this. See how all these lows were taken out, and then eventually the price did find the bottom and boom, took off, right? So this is below all of these levels. So we like those extreme lows. That's where we look for those reversals using the candle range theory. So in conclusion, this is best for swing traders. If you're an impatient person, don't try this. It won't work. Just stick to the candle range theory. You'll get your profits faster and you won't have to wait that long. Be sure to watch if price comes back to the 20 EMA. Generally speaking, the 20 EMA, that blue line on the chart, it should hold price if you got the overall trend right. It may retrace to it some, but ultimately it should bounce off of it. It won't stay above it or below it too long if you got the direction right. Again, short above the prior month high or prior week low, or prior month high and prior week high. Look to go long below prior month low or prior week lows. The indicator for mark levels is best for that, to show you those levels on a clear chart. Risk management is still going to be number one. So again, I only teach one entry. If you take one entry on this for like 10 bucks a pip, that could be as much as $1,000 to $2,000 or even $4,000 if you held for the whole ride. So you just have to determine what you want your profit to be. But again, one entry is more than enough to trade and be successful with this. So find your specialty. Maybe you want to use one account to day trade, one account to swing trade. It's up to you. It's your business. You run it as you see fit. So I appreciate you watching. Please subscribe, comment, like the channel. For everything else that you want to see, leave a comment. I appreciate your time and attention, and have a great rest of your day.